There are strategies hedge funds whisper about in closed rooms, but you'll almost never hear them explained to retail traders. One of those strategies is delta hedging. And today we're pulling back the curtain to reveal the delta hedging secrets institutions don't want retail traders to know. Welcome to Derivatives Trading Mentorship, the channel where we uncover the real mechanics of professional derivatives trading. If you want direct access to our proprietary delta and gamma hedging levels, the same type hedge funds actually use, visit us at www.derivativestrading.com. The surface level explanation most traders get. If you've heard of delta hedging, you've probably been told it's just a way to reduce risk. The explanation usually goes like this: each option has a delta. If you're long options, you hedge by shorting the underlying. If you're short options, you hedge by buying the underlying. And while this is technically true, it's not the full picture. This is the textbook version, the part institutions are happy to let retail traders believe. The real secrets lie in how professionals use delta hedging as both a defensive and offensive tool. Secret number 1. It's not about one hedge. Retail traders often think of delta hedging as a single adjustment. You calculate exposure, offset it with shares or futures, and you're done. But institutions know that delta isn't static. It changes with every tick in the underlying gamma ensures your delta exposure accelerates as the market moves. This means delta hedging is not one action, it's a continuous process of rebalancing. And it's that flow of constant adjustments that drives liquidity and volatility in the market. Secret number 2. Hedging flows move the market. Here's the part most retail traders never realize. Delta hedging flows don't just protect positions, they actively move markets. When dealers are short calls and the market rises, they must buy underlying shares to hedge. That buying pushes the market even higher. When the market falls, they're forced to sell, accelerating the decline. This is why markets often rally harder or fall faster than expected. Hedging flows are amplifying the moves. Professionals don't just hedge against this, they anticipate it. 3. Neutrality is a myth. Retail traders are often told that delta hedging creates neutrality, but true neutrality is fleeting. Professional desks understand that perfect neutrality doesn't exist. Instead, they operate within zones of neutrality levels where their exposure is controlled even if it's never zero. The secret is not eliminating risk completely. It's knowing which risks you're exposed to and when to adjust. 4. It's a profit tool, not just protection. This is the biggest secret of all. Institutions don't just hedge to survive, they hedge to profit. By dynamically adjusting their delta exposures, hedge funds can capture volatility through rebalancing, generate returns from market movement itself regardless of direction, use delta hedging to support structured strategies like dispersion trades, volatility arbitrage, and relative value plays. For retail traders, delta hedging looks like a shield. For professionals, it's both a shield and a weapon. Why you don't hear this in retail education? Most retail courses stop at the basics because advanced hedging requires proprietary calculations and constant monitoring of gamma, vega, and theta. That's what institutions invest millions in models that track these exposures in real time. At Derivatives Trading Mentorship, we've built our own proprietary data based on real market-making experience. Our delta and gamma levels are the same kind of numbers banks use every single day. You can access them now at www.derivativestrading.com. The takeaway? Delta hedging isn't just about reducing risk. It's about understanding the hidden flows that drive daily markets. The secret is simple. Retail traders look at charts while institutions look at exposures. And by mastering delta hedging, you start to see the market not as random, but as structured, predictable, and driven by flows you can actually anticipate. That's the edge professionals keep to themselves. And that's the edge we share here at Derivatives Trading Mentorship. If you found this video eye-opening, subscribe now for more deep dives into the strategies banks and hedge funds rely on. And remember, if you want direct access to the same hedging levels shaping today's markets, the link is www.derivativestrading.com. Thanks for watching Trade with Precision, think like an institution, and never forget, what looks like random price action is often just delta hedging in disguise.